Welcome to This Explainer. Look, if you've got money invested in the Indian markets, what we're talking about today is absolutely crucial for your portfolio. We're diving into the staggering numbers and, frankly, the fascinating mystery behind India's largest private bank, HDFC Bank. Now, if you follow the financial markets, you already know that bank earnings are a massive event. But recently, we witnessed something that left a lot of folks scratching their heads. We saw a true profit paradox. So today, we're going to decode exactly what happened with HDFC Bank's Q1 FY27 results and look strictly at the data to see what story the numbers are actually telling us. All right, let's jump right in. In the first quarter of FY27, HDFC Bank pulled in a standalone net profit of, get this, 19,060 crore rupees. I mean, just let that colossal number sink in for a second. In absolute terms, that is an eye-watering amount of money. It represents a 5% year-over-year growth, and their net interest income grew by around 7%. Honestly, if you were just skimming the headlines, this looks like a remarkably solid quarter for a massive financial institution. But here's the crazy part. Immediately after this earnings announcement, the stock tanked. It plummeted over 5%. So on paper, it sounds like a huge win, but investors clearly didn't see it that way, and they started selling off. And this is exactly the paradox we're looking at today. Why in the world would a record profit of over 19,000 crore rupees trigger such a negative reaction? Well, to figure out this mystery, we've got to look way beyond that headline profit number and examine what these results are signaling about the bank's future. Now, to really grasp why this sell-off is such a big deal, we have to talk about scale. The Reserve Bank of India actually classifies HDFC as a domestic systemically important bank, or DSIB. Along with SBI and ICICI, HDFC is, quite literally, deemed too big to fail. They are the absolute bedrock of the Indian economy. So, when a bank of this magnitude hits some turbulence, it's never just a localized event. It sends ripples across the entire financial ecosystem. To put that too big to fail status into perspective, think about this. According to recent ratings by ICRA, HDFC holds a whopping 14.4% market share in the entire Indian banking sector's advances. Plus, they hold about a 12% share in total deposits. And if you narrow that down to just private sector banks, their share skyrockets to over 36% of advances. By assets and market capitalization, they are by far the absolute largest private sector bank in India. And this immense operational scale spills right over into the stock market. HDFC Bank holds the single highest individual weightage in the Nifty 50 benchmark index. They're sitting at approximately 11%. Reliance Industries is behind them at 9%, and ICICI Bank is at roughly 8.5%. Because its weightage is based on free float market cap, HDFC's stock volatility literally physically moves the entire Indian market. Basically, when HDFC sneezes, the whole Nifty 50 catches a cold. So, if the bank is this dominant, literally this critical to the economy, and highly profitable, what actually spooked the market this quarter? Why the sudden 5% drop? Well, the answer isn't actually found in what happened this past quarter. It's about a lingering issue from the past. It's what we're going to call the 2023 merger hangover. To find the root cause, we have to rewind historically to a massive corporate milestone. Remember the merger with their parent company, Housing Development Finance Corporation, or HDFC Limited? It was announced back in April 2022, and it officially wrapped up on July 1st, 2023. Fast forward 3 years to today, reporting Q1 FY27 results in mid-2026, and the bank is honestly still fundamentally digesting this massive integration. See, while that historic merger gave them unprecedented size and completely transformed their balance sheet, it also handed them some pretty heavy baggage. HDFC Bank had to absorb HDFC LT's liabilities, and that included inheriting a massive book of legacy high-cost mortgage borrowings. The catch is, these borrowings cost a lot more to service than your standard retail deposits. And since the cost of funds hasn't really come down, those legacy liabilities are acting like a heavy anchor on their operational efficiency right now. And that brings us to the absolute holy grail metric in banking, which is exactly what the market freaked out over: net interest margin, or NIM. Simply put, NIM is the profit markup a bank makes. It's just the difference between the interest a bank earns from lending out money and the interest it has to pay out to its depositors. A lower margin means the bank is earning less from every single rupee it lends, even if they are making a ton more loans overall. Now, when you compare this metric against their biggest rival, the problem hits you right in the face. In Q1 FY27, HDFC Bank's net interest margin got squeezed to a record low of 3.26%. That's down from 3.38% the previous quarter, and it is the lowest it's been since the merger. On the flip side, look at ICICI Bank. Their NIM actually improved to a super healthy 4.36%. That is a massive gap in core banking profitability, and it's being driven directly by HDFC's elevated cost of funds. Because of that nasty margin squeeze, HDFC's headline profit growth looked, well, kind of sluggish, sitting at just 5% year over year. Contrast that heavily with ICICI Bank, who posted a really robust 15.9% growth in standalone net profit. When the two largest private banks in the country report earnings within a day of each other, the market is naturally going to compare them. And on the surface, one looks to be compounding smoothly while the other looks heavily weighed down. But hold on a second. Before we completely write off HDFC's quarter, we really need to peek under the hood here. Because that 5% headline growth for HDFC, it's actually a bit of an illusion. In financial analysis, you always have to double-check the base quarter you're comparing against. Comparing Q1 FY27 to Q1 FY26 isn't exactly an apples-to-apples comparison, all because of a major base effect anomaly. Here is why. Last year, in Q1 FY26, HDFC Bank's profit was artificially inflated. They recorded a massive one-time gain of roughly 6,949 crore rupees. They got this huge windfall from selling a portion of their stake in their subsidiary, HDB Financial Services, during its IPO. So that baseline profit they were trying to beat this year, it was heavily skewed by a totally one-off event that had absolutely nothing to do with their core day-to-day banking operations. So as market analysts have been quick to point out, if you strip out that one-time windfall from last year's numbers, HDFC's underlying core profit growth this quarter is actually meaningfully stronger than what that 5% headline suggests. They're actually performing much, much better operationally than that single percentage figure implies. The core business is holding incredibly strong, even if the headline number is kind of masking it right now. Actually, if we look at the full Q1 FY27 scorecard head-to-head, it's definitely not a one-sided defeat for HDFC. I mean, look at the absolute profit. HDFC's 19,060 crore still easily dwarfs ICICI's 14,804 crore. HDFC also outright wins on overall loan book growth, expanding their advances by 15.4%. And crucially, HDFC even beats ICICI on asset quality, boasting a lower gross non-performing asset ratio of 1.17% compared to ICICI's 1.38%. So here's the absolute crucial takeaway. The market's negative reaction, that 5% drop in the stock price, it really wasn't about the absolute size of the profit. HDFC is still an absolute juggernaut. The sell-off was purely a reaction to the quality of the earnings. Investors saw those record-low margins, they saw the stubborn cost of funds inherited from the merger, and they basically decided that right now, ICICI Bank simply had the cleaner, more efficient quarter. Ultimately, the market chose quality of profit growth over sheer quantity. Which leaves us with a really fascinating question to chew on as we watch the markets over the next few months. Is HDFC Bank's current margin pressure and stock volatility just a temporary merger hangover that's going to eventually fade away once they fully digest HDFC LT's legacy debts? Or are we actually witnessing a long-term structural shift at the very top of India's banking hierarchy? You'll definitely want to keep a close eye on those margins going forward. Thanks so much for joining this explainer.